Let's say you're an American app developer. Your software is a massive hit, and a company in Tokyo wants to license it. The deal's done, the money's on its way. But how much of that cash is actually going to land in your bank account? That's exactly what we're going to break down today. The super important tax treaty that handles royalties between Japan and the US, and how knowing the rules can make a huge difference for your business.
So let's start with this number, 20.42%. This is the default. It's what Japan automatically withholds in taxes on any royalties paid to a foreign company. Think about that. Before a single dollar of your revenue even leaves Japan, the government is going to slice off over a fifth of it, right off the top.
So where does that kind of weird number come from? Well, it's not just one tax. See, it's a 20% base income tax, plus a 2.1% special reconstruction surtax that was put in place after the 2011 earthquake. Now, that extra bit is technically temporary, but temporary here means it's on the books all the way until 2037.
For any U.S. business licensing its intellectual property to a company in Japan, this is the default danger. If you do zero planning, you're set to lose a big chunk of your earnings before you even get a chance to see it. So the real question is, can you actually do anything about it?
Oh, you absolutely can. And the answer is found in the Japan-US Tax Treaty. Specifically, we're talking about Article 12, which just completely changes the game for U.S. businesses. It's this powerful tool designed to turn a major tax headache into a huge advantage, encouraging ideas and technology to flow freely between the two countries.
I mean, the difference is just night and day. On one side, you have Japan's domestic law with that 20.42% tax. But on the other, you have the U.S. treaty, which says that tax rate should be 0. That's right, a complete exemption from Japanese withholding tax. It's all about preventing that dreaded double taxation, so the income gets taxed in the U.S., not in both places.
So what exactly gets this incredible 0% rate? Well, the treaty's definition of a royalty is pretty broad. It covers payments for things like copyrights, for software or movies, patents, trademarks, even for things like trade secrets and know-how. But here's a key distinction. Licensing your software code, that's a royalty. It gets the 0% rate. But getting paid to fly over and install it, that's a service, and it gets taxed in a totally different way.
But, and this is a big but, just like with any powerful tool, you've got to know how to use it the right way. That 0% rate isn't automatic, and there are 3 major exceptions you absolutely have to be aware of. Getting this part wrong can bring that nasty 20.42% tax right back into the picture.
The easiest way to think about these is like a simple checklist. You've got to consider your business footprint in Japan, you've got to make sure you're charging a fair price, and you have to be the real owner of the income. Let's break them down, one by one.
First up, the business footprint rule. If your U.S. company has a physical presence in Japan, what the treaty calls a permanent establishment, think a branch office, and those royalties are directly connected to that branch's business, then yeah, the 0% exemption is off the table. That income gets taxed in Japan just like any other local business profit.
Second, we have the fair price rule. This kicks in when the company paying and the company receiving have a special relationship, like a parent company and its subsidiary. So imagine a U.S. parent company charges its Japanese subsidiary a crazy inflated royalty. If the fair market value is, say, $100,000, but they charge $150, well, only that first $100,000 gets the 0% rate. The extra $50,000, Japan can tax that.
And finally, there's the no middlemen rule. This one is a really critical anti-abuse rule. To get the treaty benefit, you have to be the beneficial owner of the royalty. In other words, you can't just be a shell company set up in the U.S. to funnel royalties from Japan to a resident of some other country. That's a practice called treaty shopping, and this rule is designed to shut it down, period.
Okay, so you've navigated the exceptions, you've confirmed you qualify for the 0% rate, fantastic. Now, how do you actually make it happen? This is where we get into the practical, need-to-know steps.
The good news is the process itself is surprisingly straightforward. Honestly, it all just comes down to doing your paperwork ahead of time. You file the right form with the Japanese tax authorities, and that gives the company paying you the official green light to use that sweet 0% rate right from the very first payment.
This is the form that does all the heavy lifting. It's officially called the Notification for Tax Treaty Relief, and it goes to Japan's National Tax Agency. Now, here is the most crucial detail, the part you absolutely cannot forget. It has to be filed before the royalty payment is made. If you're late, the company paying you is legally required to withhold the full 20.42%.
But what if you miss the deadline? What if the tax was already withheld because the form wasn't in on time? Okay, don't panic. You're not completely out of luck. You can file a claim with the Japanese tax authorities to get a full refund, and you have a 5-year window to do it.
So let's zoom out and go back to our American app developer. What does all this mean in the grand scheme of things? Well, what we've really been looking at is this fascinating dance between a country's domestic tax law and an international treaty that's designed to make doing business across borders not just possible, but profitable.
The takeaway here is crystal clear. Without the treaty, you're looking at a major tax hit that might make the deal not even worth it. But with the treaty, and by correctly following its rules and paperwork, that entire tax burden just vanishes. It's a massive incentive that makes these kinds of international deals work.
And all those exceptions we talked about, the business footprint, the fair price, the beneficial owner rule, they're not just fine print. They're part of this very delicate balancing act. So the next time you hear about a big cross-border business deal, you can ask, is the tax treaty helping create genuine innovation, or is it being used as a clever loophole? It's a debate that is shaping the future of our entire global economy.